What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. Today, I'm joined by Bill Baruch, President and CIO of Blue Creek and Blue Line Capital. In this episode, we'll dive deep into Bill's outlook on the markets, exploring why he believes by in May, the bull market is here to stay. We'll discuss his short-term and long-term perspectives, analyze market divergences in the indices, and hear his thoughts on the driving factors and longevity behind the AI boom and the rally in metals. Join us for an insightful market overview from a seasoned trader and investor. Let's get started. Today's podcast is sponsored by FTSE Russell and TradeStation. FTSE Russell is the home of the Russell 2000 Index. Did you know that with an 81% share and $1.6 trillion in institutional assets benchmarked, the Russell 2000 is the top choice by far among institutional investors? Like all Russell U.S. indexes, it's rules-based, transparent, and reliable, regularly updated with the latest IPOs and annually rebalanced. To learn more about FTSE Russell and their products, please go to FTSERussell.com. Serious futures traders, level up your skills with TradeStation's powerful platform. Enjoy flexibility, superior trading power, and save big with 50% off brokerage fees for the life of your account, and get 10% intraday margin rates on 3 popular futures markets. Open a new futures account today at tradestation.com/Anthony. Bill, welcome back to the show, my friend.
Thanks for having me. It's always a pleasure to join you.
Great to have you back. First day of the month in June. What stood out to you today?
Volatility in the equity markets continue. I mean, it's almost like a 100-point range, 2 sessions in a row, building quite a bit of support in the S&P out above 5,200. Good, strong close. I think, again, seeing that 2 days in a row, just ramp into the close. So see how that continues into the week. And, but we're also seeing some data, economic data start to weaken a bit. End of last week, we saw PCE was a bit touch lower. Today, we have ISM manufacturing. It was a pretty solid miss, and the markets responded to that. A lot of data ahead here as the month gets going, though.
Yeah, and we saw rates this morning come off a little bit in terms of yields. You saw a little bit of a bond market rally. What are your thoughts on what rates and, bond and treasury markets have been doing thus far?
I'm a believer that rates come down. And it's not something that I'm, really leaning into from a trading perspective on the treasuries themselves. But I do think rates come down as the year evolves. Some of that's from a deterioration of economic data that we're beginning to see. Some of that with the job market, I think, is comes off that, how tight it's been. And then overall, I am a believer that inflation, sort of, it's not rising as many think. So I think I'm sort of trading accordingly around that, but I'm not trading the treasuries as much. But I think rates start to come down, and we may have seen a bit of a peaking here in the past couple of weeks.
I can't disagree with that from the charts. And I think that really ties into what you actually tweeted last month. You said, buy in May, the bull market is here to stay. And I think part of that, maybe we'll have you comment on that, is if whether or not maybe you thought rates have somewhat peaked. And I think while the markets they've been on this rally, and like we've seen today, I mean, no matter what you try to do to push them down, they come back into the closes. These rallies into the close have been crazy, Bill. Let's start off with comment on that. Buy in May, the bull market is here to stay. Talk about the overall current market conditions, which make you believe that is the case. And I also, because you follow a lot of stocks and sectors, talk to us about what top sectors or names you're watching for leadership.
Absolutely. Buy in May, this bull market's here to stay. Really began more seasonal. We saw, especially in an election year, the market really softens in April. And I think this year really lined up very well. We had a ton of strength the first quarter, almost over strong. It almost kind of overshot itself. And so it was time for it to come in April. But right as everybody starts to get negative, maybe it's time to consolidate. Really, in an election year, you start to see strength show up, whether it's the end of May, middle of May, or maybe as late as middle of June as the summer starts to evolve. But because of that weakness we had in April, and I think looking at it from a chart was, do we see that rebound out of the lows and this really, which was, through the middle part of April, does that turn into last autumn, where the September fallout and then we rebounded a bit again, and then we fell out farther in October, or were we just going to take off? And I think it was more about the constructive patterns that continue to take place in May. There's these little consolidations or late April into May that continue to build on themselves. And I think that was very constructive. And overall, I think in an election year, you got to, the way this year set up too, looking for the S&P to finish up at least 20% this year. So I felt like there's the consolidation here gave you a lot to build on and sort of measuring your downside. So that was one of the things that gave us confidence too. Earnings overall have been solid. In year two of a bull market, we had tech really start to take off, but year two of a bull market, a lot of leadership can really show from the financials, from the healthcare, even some cyclicals with industrials, but utilities typically show up very well in a year or two of a bull market. So if we're going to start to see new leadership while there is still current leadership within tech, it leans into a bull market continuing this year. And I think things have played out over the past 60 days to really lay out good groundwork. And that's why, even those last two sessions, we're getting tremendous buying into the close. I'm not necessarily sitting here convinced that a low may be in from Friday. I'm sort of taking it with a grain of salt for right now as a lot of data plays out and we lead into the Fed next week. But I think we could potentially see this build out pretty nicely and set up for a nice little summer move.
Yeah, and I think that people forget that markets don't crash from all-time highs. When you're making all-time highs the way that we have been, I think from a technical perspective, a lot of times traders are always looking for the top versus the pullback just to buy for another continuation to all-time highs. And I think, you get people set up thinking, oh, the high may be in for May for the year. But like you said, everything really kind of around us has been kind of floating higher, except for the Russell, which I think we'll get to that. But I want you to comment maybe on the utilities. Utilities have been really ripping higher. And a lot of people, at least from when I first started in the industry, would say anytime you see those defensive or those areas of the market start to come up, you want to take note that maybe, just maybe, that's a sign that weakness is about to come, because you're seeing a lot of flows into utilities. And I know that is obviously AI driven because I think we're in a unique time, but I'm curious about what you're seeing within the sectors that give you the confidence that the bull market really is here to stay.
Yeah, I think starting with utilities, as you mentioned, the AI and the power demand, I think, is going to be something that's going to continue to help you a driver here. But if you're looking for where the puck's going next, and you think, okay, if yields are going to come down, and that's how we're looking at and building out a lot of our portfolio right now, and saying, okay, yeah, we're confident in tech. In fact, NVIDIA is still our number one position. Even every time I try to trim that a little bit, it roars higher and becomes our number one position again. And we're very top heavy with tech. But as you build out the rest of the portfolio, especially those that where fixed income is important, you want to understand where the puck is going next. And you don't want to be, caught looking at a free launch, say, in a money market. Yeah, it might be nice, but a lot of money could be looking at where's the next yield. So especially if yields are coming down or do come down later this year, that's an important thing to look at. Utilities, they're going to hold higher, better yields potentially, and that's going to be something that continue to be a driver there. As we look in, we started off talking about treasuries, in the fixed income portions of our portfolios, really building out intermediate duration right now. We had very ultra short duration and kind of looking at, okay, if yields are going to come down as well, let's plan for that. So I think that's a tailwind to utilities here. And then, overall, cyclicals in a bull market, look at financials doing well. I mean, today's GDP number, really, 1.8% from Atlanta Fed GDP. There's a pretty heavy revision down from the 2.7 it was. But, growth has remained fairly strong. That's something that's been driving the cyclicals. Even if some of the data, some of the ISMs show a little bit of softness, I think the cyclicals are there. Now, you look at a day like this too, though, industrials got beat up. It is a pretty poor manufacturing number. So, I think there's definitely going to be wonkiness, but when you back out from the day-to-day swings, utilities, kind of coming back to that conversation, utilities are something that's showing some really great strength. They've been an underloved space. And that's one thing I like to look at too, is finding something that may be underloved. And when people start to wake up to it, that's where some tailwinds can really start to come. I think that's where financials are starting to find. I mean, we know last year financials were certainly very underloved, and you're getting some tremendous strength in names like Bank of America, JP Morgan, even bouncing back after a little bit of headwind from Jamie Dimon. But the financials are looking pretty strong. That's something that I'm paying close attention to right now as well.
Let's talk about the energy market that continues to drift lower now. What's your thoughts on that and how maybe that starts to impact, I think, the overall bull market?
Yeah, crude oil just got bludgeoned to start the week. Sort of broke out of that really tremendous support level that was on WTI, where it was about 75 and a half, 76 and a half area from where it consolidated in March. So to see that really surrender here today, I think is a little worrisome. At best, a little worrisome. I've recently started adding a little more energy, maybe a day too early. I added ConocoPhillips at the end of last week as a new position in portfolios. I like the merger acquisition, of Marathon Petroleum. I think that's a really great setup. And I think that's been a key theme here in the energy space in general. Some consolidation, look at some of the larger names are looking to reduce costs, some integration there that's going to help them and increase free cash flow. So, you look at whether it's Chevron and Hess or Exxon and Pioneer, kind of Conoco and Marathon Oil, when they're acquiring names like that, it shows there's value in the space. So that's a positive. And a lot of these analysts are marking energy still to like $60. So it's a lot of these companies' balance sheets, when these analysts are doing their work, are marking it to $60 oil. So, as long as we stay above, 70 per se, I think there's tremendous value from the energy names. But when you get to WTI, I think this maybe could be a little reaction, a negative reaction to some of the OPEC meeting. Maybe they didn't do enough. I haven't been able to bury myself too much into what may be the exact driver here today. Some technical selling as well. But, I'm watching that, underlying crude oil very closely here in the coming days to see if we can't bounce back. And again, I think ISM manufacturing may have had, something to weigh on that. I'm broadly saying when you look at retail sales data or some of the better GDP data we've had over the past 6, 9, 12 months that have surprised everybody, that's been a tailwind to crude. I mean, those days when you see that data come in strong and yields are higher and the stock market may be knocked off a little bit, crude oil is typically stronger on those days. So it's not surprising to see it lower, but I am a little worried seeing some really technical damage on the chart now. It's going to create some pretty tremendous overhead supply to get back above $76, $77 in WTI.
Yeah, oil's like a catch-22, right? I mean, if it's going up too much too quickly right now, everyone says, well, so much for inflation going away, right? And if it starts to go down, everyone says, well, there's not enough demand for crude. So, we're in a slowdown. And so, how does it all fit in the context of it? But I think you laid it out really well. Like a lot of these companies, when you look at oil stocks, they're still making money. They may not be performing as well as some of the other sectors, but that makes sense right now, I guess, in this environment. So much of your strategy so far, it sounds like it's building on the fact that rates are at least going to stay here or coming lower, right? More leaning towards coming lower, definitely not looking like they're going to go higher. I want to talk about the divergences in the indexes. Obviously, we have NASDAQ leading higher. We know the NVIDIA story, right? And AI and how tech has been leading that rally. S&P, we talked about some of the sectors and why it's kind of push and pull. Oil not doing so well, but yet utilities, financials, and tech is doing really well. Russell 2000, very tied to rates, can't seem to get, off first base. I mean, every time that market tries to go higher, I've seen more breakout charts, Bill, on X, and it's going, here we go, and then bang, it comes right back in. At what point do the small caps start to believe what you believe, that rates are coming down and the bull market is here to stay?
That's a tough one. I mean, listen, I've been right about a lot of things this year, and I've been wrong about a few things too. And I mean, now I haven't sort of leaned into, make or break on Russell. We have an allocation, a tactical allocation to IJR in our portfolios. Typically, we keep that around a 3 or 4%. Coming into the year, I increased that to 5% allocation, thinking that we could get some stable outperformance potentially from there. Maybe not in the first quarter out of the gate, but as the year unfolded, that there'd be some catch up. And hey, I'm wrong on that little bit of overweight. It's just been every time you see the market, the Russell from a trader's perspective too. Even today's a great example. On Monday, the first day of June, 2100 in the Russell 2000 futures, I think 2104, and within maybe 5-10 minutes of the opening bell, the thing was unchanged. Down, it gave up 25 points. And turning red on the session, or at least new lows on the session, down to 2075. It's been really a tough one to see sustained gains. And like you said, it's very rate sensitive, and I think that's really, I mean, maybe people really aren't believing that the rate story, and then also other headwinds. So if rates are going to come down, that's great, but why are they coming down? Is it really they coming down today significantly because the ISM manufacturing data? And is that going to be, okay, are these companies deteriorating? Another really interesting fact is like small businesses in general. Small businesses, now these aren't small cap stocks, but give you a pulse on on some of these names in general. Small businesses make up 60% of all businesses in the country, and the small business survey is deteriorating, just tremendously deteriorating. So that kind of gives you, they might be a little smaller than the companies you're seeing in the Russell 2000, but it gives you a pulse on where that push and pull is. I mean, these aren't large cap names with fortress balance sheets and tremendous cash flow, and really their own becoming like. See, look at these mega cap names. They're like their own banks. These Russell 2000 names, they're not like that. It's a really tough push and pull, and I'm just as confused as some people out there may be. It's something that usually when you see such divergence and really look back at history, you get the concentration in the large caps, and even I think it was the 80s, it was the Exxon and AT&T and Kodak, and you get the underperformance in the small caps. It's like an alligator jaws, and that thing sort of closes up, and we just haven't gotten that over the last year as one would expect.
Let's stay on the Russell 2000 for a moment. We got Russell reconstitution at the end of the month. It's usually a seamless transition, as the Russell reconstitutes at the end of June. Let's just say that the Russell does start to participate in this rally. Do you think that's an overall bullish sign, or do you think that maybe money starts pulling out of these sectors that have been running higher? Or if Russell starts really leading lower, rates kind of just stay where they are, how does that look for the overall indexes?
I think if people start stretching for performance, the Russell 2000, that I think that helped it towards the end of last year a bit. I don't think we're in the same situation where there's more believers in a bull market this year. Obviously, it's year two, but I mean, you lean into some of the cyclicals and some of the financials and healthcare that can really drive the year two to bull market, and that the Russell 2000 makes up. It has quite a bit of financial exposure. It's really tough to say, but I would imagine as, the puck may move a little bit away from tech at some point this year. A lot of the expectations start to get built in. You see that in software right now. Software is going through its own little, bear market. Look at Salesforce last week, a big name like MongoDB that a lot of people follow. Some of these names are just getting hit in the software space. You start to see that start to take place. And maybe that could be a little bit of a rotation thematically, but more broadly, and from some, as people look for, okay, where can I go to get some outperformance? And that could be, the Russell 2000 become an answer if yields are down a little bit. I think the worry is you hear like Jamie Dimon, you hear a lot of banks, they're very fearful that rates are going to stay up. Now, I look at Jamie Dimon, I have massive respect for him. I think he's tremendous, big fan of him. But when you start to hearing some of him and people cut from his cloth start talking about rates at really high levels, typically that could somewhat be the high end of a rate cycle because they're used to seeing rates at such high levels going back in the 80s and 90s. It's normal for them. And I think we're in a different economy now, a different place right now. So I think there's some fear from that angle that you're going to start to see, you're going to see rates stay up for an elongated time. But if they actually do start to come down and you get the 10-year below 4%, maybe that is that sort of that marker that sort of is a green light for small caps, because at that point, they can start to roll out and push out different debt packages that they have that's on their balance sheet and gives them a little more flexibility, because that's really the fear. Maybe rates come down a little bit, but are they down long enough to really make it a value for some of these names to roll out debt that's really weighing their balance sheet down?
Yeah, I'll be curious to see what shakes out if rates do start to come down a little bit in tech, because like for me, I manage a portion of my long-term portfolio and I've actually been trimming some tech. And like you said, every time I trim it, it goes up again. And I'm always like, and I've been waiting to buy Russell. It's just my thinking, because I'm like, okay, this stuff is done amazing. Take some money off the table. It's never a winner until you bank some. And this is my long-term stuff. And I'm thinking about it going, I'm slowly getting out of that to eventually get into if rates come down into the Russell. So that's why I was curious what your thoughts are on how that dynamic would look if the Russell does start to go. Because if you go back to even last November, you remember when basically the Fed said, hey, we're done, mission accomplished. I mean, Russell rallied 5% in a month. I think it was the biggest Russell ever, rally in the Russell ever. So, not that I'm trying to catch that move again. I kind of am, but it's one of the things I'm looking at. But I want to talk about futures for a second, because actually one of the ways that I'll allocate into like Russell 2000 is like through micros. I'll just keep buying micros in really small position. It's a way, because I'm a futures guy and I know you are as well, but you're somebody who's actually a pro on both sides, which is rare. I mean, most people are either futures or stocks. I know where I'm at. It's definitely the future side, and so that's why a lot of times I'll use like micro Russell to be able to participate in those types of moves as I accumulate them. How do you utilize futures in your portfolios?
That's a topic that I love to talk about. And, I think, You and I were talking about it before. I think it's 2019. We had a conversation my whole theme has always been, you don't have to be right now. And the micros really was a game changer for the strategy I was utilizing. So cutting my teeth in the future space, a lot of the time as a broker, I was giving coverage to, family offices, large traders, people with, a few hundred contracts on an E-minis, NASDAQ, S&P, sometimes up to 1,000 contracts, and really helping them manage the risk, give them coverage, help them pinpoint their entry and exit points, and helping them across that point, and sort of used to taking on a lot of risk. But if you're going to be sort of a fund manager, like when I'm running a CTA, a commodity trading advisor, you don't want 20% swings a month. So you have to hunker that down. You won't get any client. You won't keep your clients per se, at least if you're having 20% swings per month. So micros were that answer for me. I was able to build a core position, be able to size properly. I facetiously say, listen, I may not be a genius, but my superpower is sizing. Sizing positions properly will get you through times. And I think that's really where the micros are crucial. And a lot of times, managing positions with stops and being able to get back into a position if it doesn't close down below a certain level, managing part of a position so you're not all in, you're not all out, you're not putting your back against the wall. And these micros of the CME group has been able, not only there's the equities, but looking at gold and copper and crude oil and other names, it's allowed you to really build out as a trader. And I love trading around a core position. So for instance, if somebody's looking at the Russell 2000 and they say, hey, I want to start allocating the Russell 2000, micro Russell 2000 is a great place to be looking to do it. And you can layer down to build a core position. Heck, we have a bad close on a Friday, peel a little off, wait till, and you can always get back in a little bit. So, that being able to manage a position in that manner brought me a lot of flexibility. And it is actually a big tailwind to why I started a CTA and why I have a fund, is being able to have that flexibility.
Yeah. I mean, you think about the micros and you could utilize them in so many different ways. If you're a trader or an investor, you can scale in a bunch of micros and get as big as you want and day trade them. You can scale into them over a period of time, which is what I do a lot of times. And actually some of my biggest winners in terms of just single trades have been in micros over the last year and a half. I had a really good one in crude oil. I had a good one in Russell as well, one that you're accumulating, because you don't want to get blasted the second you get in. And especially when you get a tape that's really choppy, like the Russell right now, if you want to accumulate, it breaks, 30, 40, 50 points, buy one, and I think it's good to hear from your perspective too, managing it on the professional level and how that looks, because I think that so many traders out there are so narrowly focused on just for today that they forget about these tools that CME has, with these smaller micro products to be able to actually help you take advantage of these bigger moves. You don't have to take advantage of it today. Helps you take advantage of it over time.
Yeah, so our unit size is $250,000 per unit with our global portfolio. And, ultimately, I'll build a position with micro S&Ps anywhere between 3 to 5 contracts. And then, anywhere between 2, 4, 5 micro NASDAQs if I'm bullish. That's the ones I lean into most. And ultimately, the core is 3 micro S&Ps and 2 micro NASDAQs. And I get up to 10 total. But as I trim down some of my targets being hit, you talk about letting, some of the biggest trades of micros. If I'm super bullish and still love tech, leaving 2 micro NASDAQs to run and just have a hard stop on it. And I don't even have to think about it, because even with the daily volatility, you get that hard stop. And next thing I know, we're 1,000 points higher. And guess what? I just added 1.5%, 2% to my month by just leaving it and forgetting about it, basically letting it go. It's rather, the E-minis. I cut my teeth trading those, like as you probably the big boys. And you're in, if your stop get hit pretty quick if you try to manage on the E-minis, the full contracts, those things, you got to be ready for it. So it's really nice to take it and allow it to play out, allow it to see it to fruition, and then when some of your targets being hit, just put a hard stop on the last couple and just set it and forget it.
Exactly. Just look at the last 2 days. You've hit the last day of the month, first day of the month. And you've had 100-point moves in the S&P. No matter where you put your stop, you're going to find it.
Absolutely.
And so there's no shame in trading micros in order for you to more precisely execute your strategy. I think it's such an important point, Bill. I want to talk to you about your trading, your investing strategy, and how you maintain a big picture outlook despite all these short-term consolidations. I feel like we've had some market environments that make it feel like they're changing in and out, but overall the big pictures kind of remain pretty steady. But when you're managing money, it's like, you're looking at these moves, like I said, they're, like you said, volatility even for today, these retracements are pretty severe. So how are you going about maintaining that, your overall big picture outlook?
Yeah, it's a really great question. I mean, you take that step back, and a lot of people put out price targets, year-end price targets, and things like that. I don't like to think in that manner. I like to think it more or less. Say the S&P when we came off that March to April low, look, okay, if this is a real low, what's a 10% move up from here? And so that, and kind of looking at it from that angle, if we're gonna have a full extension breakout and then line up other technicals across there, so kind of building my near-term target in the case this is going to be a move higher. And that puts you about like just under 5,500 in the S&P. And I mean, it's saying, okay, you want to be bullish. That's going to be your bullish. What's going to change that factor? Is it going to be, it's not just a close below 5,200 because we pulled back 1 or 2 or 3%. You may look to be trading it, but what's your bigger picture, and even farther than that? So if you take one more step farther back, I mean, okay, we're in an election year. We had a great start to the year. What are the probabilities that are being laid out for this year to type of year to continue after the start of that in the first quarter, during an election year? And so you kind of keep taking that step back and looking at a bigger and bigger picture, and not get caught in the intraday. I'll tell you too, going back to micros, not having to worry about like a 10-point or 15-point stop in an E-mini helps you focus on the bigger picture for sure. And looking at how where I manage stuff with the CTA, as well as manage stuff in a diversified securities portfolio as wealth management, they both complement each other and made me a better trader on either side. So like a commodity trader is maybe a better securities trader, and securities are maybe a better commodities trader, and helping me keep that big picture in line. And as well, writing out every day. I do write like shorter term research for clients, but getting my thoughts out and kind of even writing it in a bigger picture before you get more granular helps keep your mentality kind of what is my ultimate goal here. And then, kind of reminding yourself too, is it, if you're not trading, trying to catch 10 points, EMA, S&P, what's your big picture here? Like so is it that 10% move from the low through March and April that takes you to 5,500? Okay, then what's your bigger picture if we get to 5,500? What is this year going to bring you? What are the probabilities of this year going to stay and to see new highs, maybe 5,700 before the end of the year? And then kind of extrapolating on that. But I don't like to think too far ahead if you start getting too many things in the mix. But you also want to play devil's advocate to your view. What is going to change your view? Where will we have to close below in the S&P to change my view that we're in a intermediate term bull market right now? Maybe it doesn't break the bigger, broader bull market, but what would say that we're going to go test and maybe have an October move against that September low that we did last autumn? And so what would that happen? What would make that happen in my mind? So kind of just keep testing that view as well. It's not easy, but trying to focus on what's your bigger goal is really what the idea is.
I want to talk about metals. I'm curious, how does that fit into everything that you're looking at right now? I mean, with gold and silver gold's is on all-time highs pretty much, pretty close, and silver continues to chip away in its rally higher. I mean, copper, are we in a commodity super cycle? And if so, what does this rally in metals tell us about the world right now?
Well, it tells you that the central banks around the world are buying. China, probably getting stats here soon, but they had 18 straight months of adding to their gold reserves, a little slower the 18th month. It tells you that, fiscal spending, is getting absurd. And I think degrading, you may not see it in the currencies, but you're seeing it in hard assets against those currencies. And so, gold's priced in dollars. The dollar may not be weakening a ton, but gold sure is telling us that the dollar is weakening, just because the dollar may not be weakening against the euro today. I mean, it is today, happens to be, but more broadly speaking, I think geopolitics overall as well is definitely playing a hand. And then, the average type of move that you see on average, I think it's within the first 30 days of a Fed rate cut, you typically see a 6% rally in gold. So I think there's, a lot of these themes. It's sort of the stars all aligning that tell you that precious metals, it's their time to shine. It's their year. Silver breaking out above 30 finally. My goal would be by targeting gold, kind of seeing 2,800 from some technicals lining up, but we couldn't see that unless silver got above $30. And there's definitely a lot of truth. The fact that copper's move helps silver get above $30 too. Copper made that move above 5 well before silver got above 30. So I think, you look at China coming back online, that's been a tailwind, back online, but starting to see some growth come back out of China. Stop seeing such pessimism out of China has helped copper too, but also it comes from the supply side. I mean, there's not enough raw material of copper to even take it into the smelters and create the high grade copper. I mean, there's just the demand as the economy starts to change, that, not to go full circle back to, AI and data centers and aluminum, copper demand. So there's just sort of a circular move that starts lifting everything as the economy evolves. this revolution overall. That's something that's been a tailwind in the metals, but it's all comes back, to what, I think, look at, again, some of the real fundamentals, the fiscal spending, the macro fundamentals, the central bank buying, the geopolitics, as well as real internals within this bull move.
So you talk about the central banks buying. How does that fit in with your overall bullish outlook in stocks? And how does it make you feel about that outlook if you have this going on with central banks?
I think, obviously, if we were to have a geopolitical scare, flare up with China and Taiwan, which I don't think that's really around the corner necessarily, but I think you have to be prepared for anything. As we go into election year, I've talked about some of the strength that an election year and cycle in the S&P can bring. But also the question would be, we've seen instability in the government overall around an election. And does that encourage more geopolitical headwinds? And so I think you got to be prepared. I think one of the things that we did trim and take off overall was Caterpillar on the opening bell this morning. And now it's not that I don't like Caterpillar. I think there's definitely a number of reasons why I think maybe it's stalled. It obviously didn't have a great earnings report recently either, but they have a tremendous amount of exposure around the globe. And so I'm kind of looking ahead, where can I maybe get more domestic exposure if I think, maybe there could be, geopolitical issues. So there's some things like that I'll look at in a portfolio as well. But, I think the thing about geopolitics and geopolitical issues that drive markets is they are surprises. If it was a, known, then would it really be a geopolitical surprise or geopolitical issue? It'd already be discounted in the market. So we don't really know what's going to be the next driver geopolitically. But I'll tell you, as we look out next year and after we get through this election, in Washington, they're going to have to buckle down on fiscal spending. And that does concern me. Where does growth go from here? What does that do for the market? But, even if that does, create some sort of taper tantrum-ish news in the market, if fiscal spending were to change, if they ever hunker down, that would also help bring yields down foreseeably too, which in the end, in the aftermath of whatever taper tantrum issue would happen in the market, yields lower would be a tailwind. So kind of looking at it and playing out in my mind, not setting the pieces that were this has to happen or I'm actually playing for it, but being ready and being flexible to what could come next.
Absolutely. I think it's so important. I've had metals in my portfolio this year, and it's another one of those markets where you're looking at it going, wow, they've done extremely well. Do I just want to sell it and get out of it? Because I've been disappointed so many times before, Bill, where it's like, they rallied with stocks and then stocks kept going. I kept all this money in metals and they end up just doing nothing. But I think in this time, it makes sense to definitely keep them. I think you put that really well. I want to go back to AI again, just because it's such an important part of what's happening in the stock market this year. It is the driver. It is the theme. Do you believe AI is in a bubble?
I don't think it's in a bubble. I think we're starting to see the use cases and being tested a bit in the software side of it. And again, I think the tailwind within it all too is that the drivers in AI, if you look at these hyperscalers that are going to be the ones made and utilizing and rolling it out, these are cash cow companies. So look at Alphabet and Microsoft. We haven't even got a ton of news of Apple. Probably has the least amount of spending of the main names. Meta's increased their spending that kind of hurt them a little bit. It's sort of this arms race in AI that these balance sheets of these companies, they're in everyday products. They have great balance sheets. So I don't see it being a bubble. I think that, if you look at a name like NVIDIA, which is obviously at the heart of it all, their GPU business, maybe there, at some point it's the forecasts and the guidance, it can't go and continue always go at this pace, but they have the software to run this stuff. I mean, is a recurring theme, a recurring stream of revenue as well. And I think that, that's also being priced in that people don't really think about it, that once you start making that shift and onto these platforms from whatever angle, I mean, you're going to start paying for it and it's going to be integrated in your everyday use, whether you're a large scale company, whether you're Amazon and Meta and Alphabet that are now, paying to use the NVIDIA software and however, their data centers and being able to utilize it and then roll it out to their clients. Now their clients are paying for their software. So I don't see it as a bubble. I think, there may be some companies that have had AI tailwinds that are not going to live up to some of the expectations. And software is where my question is right now. Adobe was a big name that we held. We started closing out that position at a very good level. Then it got demolished pretty heavily just because ChatGPT rolled out a video of that could test what Adobe's able to do. Now, do I not like Adobe? I mean, I still like it. I think the company's great, but I mean, it's good. Some of the AI tailwinds that may have been priced into Adobe are going to be in question now. Look at a name like Salesforce that we just recently sold. Salesforce poor earnings report, a little bit of, maybe I've heard somebody, the great analyst with Jefferies, talk about the AI investigations. Some of these companies are investigating where AI is going to be implemented next. But while that's taking place, Alphabet's trying to buy HubSpot. So, I mean, some of these bigger companies have so much cash. I don't think there's a bubble within those. I just think some of the other use cases that we expected to see AI, and some of these companies we expected AI to be a big driver for, they may be in question. And that's where I'm trying to find right now.
Yeah, I mean, snow. I mean, I had that in my portfolio that got killed. I had it. I had a nice winter on it, and I don't remember what it was. Maybe a quarter ago, I had to dump that. I know that was a big AI theme. I'm trying to figure out some of these other plays besides Nvidia, which I've had, and even though I was a little late to the party, but still, obviously, better late than never, especially when it comes to Nvidia. What other chip stocks, I guess, should we be looking at as drivers of this AI theme going forward?
Yeah, I mean, our portfolio, like I said earlier, is very tech heavy at top. Nvidia, every time I trimmed it a little bit, and now I just try to trim it to manage it. And the way I look at it is, I'm trying to beat the S&P. I'm even, we run a concentrated portfolio that I'm trying to beat. It doesn't always have to be tech, but obviously tech is the high flying thing right now. So I'm trying to beat tech. But main portfolios, Nvidia, it runs into 6 to 7% size for us at times, even trimming it back to 4. It climbs, and sometimes kind of managing it is something in and of itself. But I love what we could be potentially seeing again from some of these hyperscalers. Alphabet and Amazon are big names in our portfolio, but you get more granular in the chips. Micron and Western Digital are two terrific names in the memory space. And I think high bandwidth memory is something you're going to start to see more and more about. It's going to be potentially the front page as you see the AI. High bandwidth memory is going to be is needed to drive AI. Another name that I like is Synopsys, and they do the electronic design automation and have contracts with NVIDIA, with other Intel and other chip makers, because the software being able to design the chips in particular for what the need case is important too. So those are some names that people may not always be watching, but Synopsys, Micron, Western Digital, the names that are staples within our portfolio for a while now.
Last question for today, Bill. We talked about your overall bullish theme of the market. What derails you from being bullish? What changes your mind?
Yeah. Well, I mean, funny thing is right now in wealth portfolios, I do have S&P put protection on. I did that a day after NVIDIA's earnings report when we kind of moved up, and I did not like the see NVIDIA. I think describing it was the market made new highs, right? And then we were kind of sitting there for a week, and I was thinking, okay, market's just waiting around for NVIDIA, and NVIDIA is going to, blow out their earnings. I was very confident in this earnings report. Okay, once that happens, then we're going to go to the next leg up to that 5475, 5500, that 10% move I was referring from those April lows. And that didn't happen. We were up. S&P reversed sharply in the first minute or two of that opening bell that day. And looking at that got me worried. We put SPY put spreads on to protect wealth portfolios. We spent 1% per position, per portfolio to do that, put that protection on. It's just a simple 520, 500 in a July put spread. And then even when I'm trading in the CTA right now, I've been trading a little bit of negative, just with puts. I've had the 5,200 end of June puts. I've been trading those as well as some Russell 2000s as well. So I'm not extremely bullish right here, but that's more of a sort of protection on the wealth, short-term trading with some of this volatility. It's worked very well, but I'm not sitting here committed to a negative downside move. And that's why I'm not trading the futures. I'm not building a core position around it or anything. So overall, I mean, I think some consolidation was needed because we couldn't break out after the NVIDIA earnings report. But I think as we go into jobs, if we're not seeing wage growth come down a little bit, I'm also seeing some worries right now too, that if we see job growth under 100K or under 125K, there's some banks out there saying, listen, it's bad news will be bad news. I'm really eager to see how the data is going to be received in, through, and after that Fed meeting. Remember last meeting at the end of April, Fed was dovish. I mean, they brought the ceiling down on QT from 65 billion or 60 billion down to 25 billion, more than half of letting it roll off their balance sheet on a monthly basis. And Fed Chair Powell basically said rate hikes are off the table. I was fairly as dovish as you could imagine them getting at that time. I mean, are we going to see them be dovish again? Are they going to play down that path? Or they take another path, sort of a Jekyll and Hyde? So I think there's a lot that's going to come out in the next 2 weeks that's going to tell us. I don't think they're going to be hawkish, and I don't think the data is going to come in too hot or hot at all. I think the trend and maybe heating up CPI, maybe rolling back a little bit. And you look at prices in the ISM manufacturing today, I think there's things that should help drive this market higher. But if they can't, and bad news becomes bad news, then I would start to be worried. And then that's where you kind of have to know, you're backing out what levels that you start to see in the S&P start to take, break down from, that will get you worried. And so my strategy in the SPY puts for wealth side would be, if we start to sell off, they're really a cushion right now. I'm not even trading those, but if we start to sell off and we really see some heavy selling, I would turn those puts and take some of the profit of those puts and give myself a floor, going out a couple more months, and sort of just that's how I would look to manage it, going forward. But if bad news becomes bad news, I would be worried.
I think that's such a great point. When bad news becomes bad news again, that's when all of a sudden the market has changed. Because right now, bad news is good news for stocks for the most part, right, Bill? Is that what we've seen in the data? Is that what you've seen?
Yeah, I mean that's been what we've seen. I mean, it's been, you've been waiting for that slower jobs report. Okay, this is going to rip the S&P, and
Exactly.
so if that doesn't happen, I'd be starting being concerned.
Yeah, well, Bill, it's been great to have you back on the show. I love seeing you continue to grow. I love seeing you on CNBC, and it's great to see a Chicago guy out there killing it. And I'm so happy for you and all of your success. Everybody, follow Bill on X, Bill_Baruch, also BlueLineCapitalWealth.com. You got Blue Creek Cap, Blue Line Futures. You're a busy man, Bill.
Stay busy. Yep.
Well, I appreciate you so much for coming on the show. I love your insight into the markets. And once again, learned a ton from you today about what's going on in these markets, and really appreciated you explaining how you're navigating them, because it's not easy out there, Bill. And so we really appreciate your time.
Thank you so much for having me on. I mean, I love joining you. I've always looked up to you and trying to follow in your footsteps. And as I look to be a trader, you're definitely one of the people that I look up to. So thanks so much for having me on.